So here is platinum's performance versus silver. So even if it went up 252%, you're still better off in silver. And silver is going to outperform gold. It's going to outperform practically all the other major commodities. So even
playing platinum there, or copper in the previous example, is like jumping on a horse, going around the racetrack and saying, I did great, and then realizing your horse finished last.
Yeah. So,
you finished the race, but you're not winning.
So instead of playing the miners or playing platinum and all that, play silver. Or play that racial chart. So if the racial chart, something else happens in the racial chart, but previous cycles have shown us that silver is just, it's, how could I say, there's no hassle, there's no CEO that could run away with the secretary, there's no bankruptcy, there's no share. It's just, it's an easy play,
CapitalCosm, my name is Danny. It is July 22nd. 2025, and my two guests today are Kevin Wadsworth and Patrick Kareem from NorthStar BadCharts. Gents, thank you again for making time to come on the show.
Hey Danny, thanks for having us on.
It's my pleasure. Yeah, for sure. Let's go ahead and dive right in here, guys. Let's get into the nitty gritty. I'll kick things off with you here, Kevin, since you're the next window next to me. What do you think should be on the radar screen for investors right now? What's gotten your main focus, considering the state of the economy, the markets, etc.?
Yeah, sure. Well, in the background to what's going on with the markets at the moment are a whole load of warning signs, and the US government 10-year yield chart is one of those. It broke out quite a long time ago, back in 2022, ending a 40-year downtrend. What that meant was that there was going to be increasing pain economically and an increasing risk of distraction techniques, plausible deniability, and a whole load of stuff going on out there in the real world that is kind of masking what is at the heart of the problem, which is mathematical, really. As debt has increased, unfortunately, over recent years, so has the 10-year yield. So I'm not sure just how much scope there might be for reducing interest rates in an environment where the bond yields are rising. You'll know that during the 1970s, when bond yields were rising, inflation was rising, and interest rates were used as a tool to try to control the entire situation. It wasn't too difficult back then because debt was falling from, or debt to GDP was falling from around 70% down to 31%. So eventually the mathematics of it all worked out, and we had a nice 40-year period of everybody having a great time. So that is going on in the background. If you expect the investment environment of the next 10, 20, 30 years to be anything like the last 30, 40 years, then completely forget that. The technical chart analysis tells us that is not the case. Stock markets at the moment haven't quite got the memo, despite a bit of a nasty breakdown earlier on this year. They've recovered on to make new all-time highs. The S&P, of course, doing well, but is approaching resistance. This means it's a risk-on period for cryptocurrencies as well. But I do worry that the window for that opportunity is short. Looking at gold, we haven't really changed too much we haven't changed anything with our roadmap. We expected the breakout to occur back at around $2,700, and in fact an earlier breakout around the 2,000 mark that we covered extensively, and prior to that a breakout somewhere down near 1,400 down here, which was covered extensively back in 2019. So you can pick your entry point, you can trade the entire move, you can play it how you like, but the story is that gold is sending a message to the markets, as it always does. And what I mean by that, we'll just take a brief look at silver as well. Silver is creating a 46-year cup and handle pattern, which is absolutely epic. You'll never see a cup and handle as beautiful as that. And the message that it's sending to the markets is loud and clear, approaching a target there on the quarterly chart, which is somewhere around about $44. May well spike a little bit higher on a sub-quarterly time frame. But silver has followed the cup and handle pattern, followed the forecast beautifully to this point. So we're nearing the point at which we could perhaps reasonably expect something to happen. When I say something to happen, we've got gold versus the stock market, which has moved sideways now for 10 years. Since 2015, the ratio for, in fact, July 2015, the ratio for the gold to S&P for exactly 10 years is pretty much exactly what it was right at the start 10 years ago. So what that means is that gold and the stock market have performed equally. The stock market has not been able to outperform gold over that 10-year time frame. And you can see a rotation taking place, which over time is expected to favor gold. It's worth noting that the NASDAQ peaked versus gold 25 years ago in March of 2000. So that was when the NASDAQ reached its maximum price measured in gold. And since then, despite various ups and downs, and we are now breaking down again below moving averages and below the support lines and everything else, despite all those ups and downs, we are now something like 30 or 40% lower than we were in 2000.
Now that's a very important chart here, Kevin, because this destroys this entire narrative that we are making new all-time highs. The markets are not at all-time highs when you price them in assets like gold and assets that aren't moving targets, unlike the dollar. So I want you to spend a little bit more time highlighting what we're seeing here. Are we? It looks like that we're showing that we're in a downtrend since
we are, yeah. We are indeed, yeah. And I said 30 or 40% down. I stand corrected, it's 60%. So the NASDAQ is worth 60% less than it was 25 years ago if you don't measure the NASDAQ in depreciating US dollars, but measure it in gold. So as far as me and Patrick are concerned, because we're in a gold bull market and trending towards a gold bull era, the base assumption is that you hold your wealth in gold. Why would anybody hold their wealth in US dollars? If you've got any money, you wouldn't keep it in the bank in US dollars because it's constantly depreciating. And certainly over that 25-year time frame, this century, in other words, the NASDAQ has been unable to regain the ground that it lost to gold, and it's now 60% down on where it was 25 years ago. We are actually now breaking down once again below this Ichimoku cloud, below the 48-month moving average. There's a 4-year moving average on there. And so this looks a little bit to me like a bear market rally for NASDAQ versus gold. So this feeds into the idea that we need to be very cautious for stock markets at the moment and for cryptocurrencies, which are benefiting from their correlation to the stock market. So yeah, and also I should have mentioned at this point that all 11 sectors bar one of the stock market are in a bear market priced in gold. So if you look at communication services, they are now in a bear market versus gold. If you look at another sector of the stock market, this is consumer discretionary. This is in a bear market versus gold. When I say a bear market, it's broken support, it's below key moving averages, below the Ichimoku cloud. You have to be above all of those to be in a bull market. And when you're below them, you are, as was back here on the left-hand side of the chart, you're in a bear market. So these periods where the chart is dropping, gold is the winner. And when the chart is rising, in this case, consumer discretionary is the winner. And you can look at consumer staples. They're in a massive bear market versus gold. You can look at, which one's this? Energy versus gold in a continual downtrend for decades now. You can look at, this one is the XLF chart, financials versus gold. It's rolled over below support, below the moving average, below the Ichimoku cloud. That to me looks like the early stages of a bear market.
But Kevin, really quick question. When you look at that energy versus gold chart, don't both tend to move in tandem though? When you're in these commodity super cycles, don't you see a move in gold as well as a move in energy?
Yeah, Patrick will probably have something to say about that. But in broad terms, yes, but that doesn't mean that they're performing equally. It doesn't mean, when I go through these charts, it doesn't mean that energy or consumer staples or basic materials or whatever it happens to be, it doesn't mean that they're falling in US dollar terms. It doesn't mean that their chart in US dollars is in a bear market. It means that they're in a bear market priced in gold. And that's significant because when they're all in a bear market priced in gold, along with all of the corroborating evidence that we have, it's telling you to expect them to be a very high risk of moving into a bear market priced in US dollars. So it's an early warning sign for these sectors, particularly, perhaps not so much energy, because as you said, oil, for example, when you zoom out and you look at oil and energy, they tend to move upwards in a precious metals bull cycle. So you're right, but overall, you can see the trend is down over the decades, and so this is all part of the picture that gold is painting. In other words, the strength of gold is telling us something significant, and is pointing to a likely incoming weakness for the stock market. You can see healthcare versus gold, massive bear market. All of these charts are in industrials versus gold, bear market. The only one that isn't, and they all look much the same, but if I skip to technology versus gold, it's a little bit more sketchy. We are below the moving average. We did break below the Ichimoku cloud, but we have hit this support line here and bounced off it. So technology versus gold, what you could say is that it's just about keeping pace with gold for the last 4 years. So technology stocks and gold, when I say technology stocks, I mean the technology stocks in the S&P, are keeping pace with gold over the last 4 years, having been in a big bull market. So a huge bull market move and now moving sideways. So gold is very, very strong, and I'll let Pat discuss some of the charts and what the implications of some of that might be, maybe.
Yeah, Pat. I mean, go ahead and add on anything you see that Kevin went over. I mean, Kevin didn't really leave you much on the table. I mean,
I was about to say that, Danny. It's like, okay, why you
meal on the table? But go ahead and comment on anything you saw, and as well as let's refer back to that energy or that gold versus energy chart. If you can kind of expand on that, what is the relationship between gold and energy? Does one run first, or does one run before the other? Go ahead and take it away.
Sure. All right, I'll share my screen. Share Chrome tab window. Okay, maybe this one here. All right, here you go. All right, do you guys see my screen?
Yes, sir.
All right. So okay, let's do the oil chart. Okay, I'll show you guys. Okay, remove all drawings, remove all indicators. Okay, here is the historical gold chart. Okay, bottom left, top right, it was pegged. Fine.
Mm-hmm.
Here, I'm going to put you the oil chart, because Kevin, he wasn't looking at oil, right? He was looking at the energy sector. It's two different things, right? It's the companies within the oil plays, right? But that's not really, if you want to compare gold to something, you have to compare it to its equivalent commodity, right? The top tier, right? The guiding commodity. So here it is. So here I'm going to put, here's oil. I'm going to do it this way. US oil, new price scale. Okay, here's my oil chart. I'm going to put that logarithmically. So this is the argument that where gold goes, oil goes. And I'll show you here, gold was pegged, guys. It was flat. So to remove some of that, I could do this one here. I'll add silver, guys, because silver was not pegged. So here's a silver historical chart. And look at silver and oil. Look at that. That's crazy, right? It's like anybody saying silver squeeze, JP Morgan, manipulation, all that stuff, guys. Well, it could be true or not true. That whatever manipulation is happening for oil, it's happening for silver, right? And vice versa. Because look at these trend correlations. Look at that. They track each other. Here's the silver went bonkers, oil, silver. Look at that. Same thing.
Which line is silver?
It's that's the US oil one. I'm going to make it the blue one here. That's silver right here, guys. I'll hide the gold chart. 2 seconds.
That's purple, Pat. Yeah.
I'm colorblind. What did I say? Blue?
Blue. Do you want to make one of them black? That might.
There you go.
Make oil black or something.
Look at that trend, Danny. It's crazy. If I put it also on a monthly chart, on a yearly chart to remove the noise, that's the yearly close. Look at that.
Wow.
Yeah. So
that is a striking correlation.
Yeah. Trend. Like maybe it's you move. So where silver goes, oil goes. Where oil goes, silver goes. And where both of those go, where gold goes.
Tracking the moves in gold, silver, uranium, or oil, with plus 500 US, you can dive into these commodity markets through CME listed futures, offering access to futures trading on metals, energy, and more with real-time market data and 24/5 trading. Their platform is intuitive, mobile-friendly, and packed with advanced tools like stop loss and trailing stops to help manage risk effectively. Start trading with just a $100 minimum deposit. Enjoy free platform access and take advantage of up to a $200 commission-free welcome bonus after account verification. Plus 500's Futures Academy and 24/7 live support make it easy for beginners and pros alike to navigate the markets confidently. Regulated by the CFTC and NFA, you can have peace of mind trading with a trusted broker while your funds are secure in a segregated account. Ready to explore commodity futures? Click on the link below to apply for your account and trade smarter. And a quick disclaimer, trading futures involves the risk of loss and is not suitable for every investor. Not all applicants will qualify.
It's all these trifectas. There's nothing special about any of them. It's mostly cycles, capital rotation event cycles, accelerations and destruction of purchasing power of your US dollar, acceleration in total public debt by the government, creating this destruction of purchasing power. All these moving parts, these macro moving parts, end up that when there's a bull run in one of them, there's a bull run in all of them. Look at that. My goodness gracious. Look at that.
I think you can probably say that whatever manipulation is taking place is tinkering around the edges. It's just a ripple in a massive ocean.
Yes.
The macro forces, the big cyclical forces dwarf all of that.
So I'm going to go back to this is the oil versus price in gold. Okay. So this is the relationship between oil and gold over since 1952. It's we've been ranging for a while actually, and oil has been losing versus gold for a while there. Look at that. So
when the chart goes down, oil's getting cheaper.
It's getting cheaper. So what you could say is here was a capital rotation event around the 2000s. Here you see oil outperformed gold a little bit all the way up here up to 2008, but after that, for the remainder of the precious metals bull era from 2008 all the way to 2012, oil gave back all its outperformance of gold. So overall, even while gold and oil and silver were going up from 2002 all the way to 2012, oil did not do as well. Gold was better than oil. And if even in the 70s, where were you? Yeah, everything went up, but after that, for a while, oil and gold performed almost the same, right? So right now, oil is really, really cheap but cheap does not mean you go bonkers, right? It will probably eventually have a rally to retest this possible descending trend line. You need 3 reactions, but gold is the kingpin of this. As per this chart there, gold has just been outperforming oil for a while back there. So yes, if we have a capital rotation event and the stock markets roll over and gold goes up and oil goes up and XLE goes up, let's look at the XLE chart on itself. I'll put candle charts, monthly charts. So
is that because, so here's what I'm seeing. When the relationship, when oil goes up, the input costs to these gold and silver miners also goes up, which creates a bottleneck in supply that way. And
well, that's the logic, because if you have the perfect recipe for the miners, then they're going to do well. So you want low oil prices, low labor costs, you want minimal industrial action in strikes and that kind of thing that are going to cause problems for production. So if you're in a good jurisdiction, you've got low energy costs, low input costs, and the price of the commodity that you're pulling out the ground is shooting upwards, then clearly that's going to show in the bottom lines of the mining companies, and as they release their results, their share prices are going to suddenly leap. And that's probably the sort of situation that we're, broadly speaking, finding ourselves in now. It's kind of a sweet spot for the miners, but it doesn't last very long, because sooner or later, as Pat just explained, oil is going to move. And when oil moves, the shine is taken away from the miners, and not from the metal.
And
so
not just from the miners, but the metal itself, because these elevated input costs that we saw, leading all the way up until 2022, could they have been a lag on gold production? Meaning that the reason why we saw a jump in the gold price over the last 18, 19 months was because of that elevated oil price from 3 years ago. And it's simply gold playing catch up to that oil price from 2022.
Right, yeah, but there's a lag effect, isn't there? You can't just ramp up mine production with a click of a finger. So there's a lag effect, and I suppose the main point from a technical chartist point of view here is that we don't need to, for a second, stop and think about the precise mechanics of how this works, other than to look at the ratio chart, because the ratio chart tells us all we need to know. When oil priced in gold breaks out, you look at oil producers, oil companies, oil-related companies, and same with the mining companies for the precious metals. If you look at GDX versus gold, is that what you got on the? You got ASA versus gold.
Yeah.
So this is the miners versus gold. So this tells you exactly how early you are in this bull market.
This is what I want to show you. This is how the miners they shine bright, they shine powerfully for a very short amount of time. Because if you're going to tell me, Danny, should I buy miners instead of gold? Since 1970, the miners have been destroyed by gold. So whatever you're playing with the miners, guys, the only thing, your best case scenario is a bear market rally priced in gold. Just like, if you want to be fair, let's say we're measuring the NASDAQ and saying the NASDAQ price in gold is still 50 or 60% below its highs of 2000s. Well, do the same thing with the miners. The miners are horrible. Look at that, horrible.
This chart, by the way, ASA versus gold. ASA is a gold and silver.
I wasn't trying to make a case for the miners. All I was saying is the miners' relationship to gold production, right? When miners have a high input cost, have very low margins, you're less likely to see more production. You're likely to see less production. Less production creates more of a supply bottleneck, and then the price of gold goes up.
But I think that was probably the case in the 1970s, wasn't it, Pat? Because if I'm right, and my memory serves me, the miners didn't outperform gold in the 1970s.
No, you see it right here that the miners did terrible in the 1970s.
Yeah, we know what was happening with energy and oil costs in the 1970s. They were rising almost exponentially, and that killed the miners.
You have to be careful also, Danny, because while people love trying to corner a narrative that really resonates in their mind, that permits them for whatever to justify the price, you have to accept that there's a narrative that is moving the price, maybe to a greater extent that you didn't fathom yet, you didn't think of yet. Maybe the company owners, they need to dilute shares and they do other stuff for other reasons, that they're not hedging properly against the rising oil costs, because even oil costs, if they go up, they could hedge and play that on the other side and protect the value that they give their shareholders. Maybe that's not in their business model yet. So while I'm just like off the top of my head, just throwing out these counter arguments or these other narratives that exist, it just has to make somebody think, hold on, if I'm not thinking of all the narratives, and honestly, how can you think of all the narratives that can drive the price of the miners? It's like, it's a non-win game. That's why we specialize in just looking at the charts, no matter what the narratives are. Here, look, here's the 2000s. The 2000s, the miners had a crate as we started having the capital rotation event, as we had that recession in 2000, as the stock market was going down and energy costs and all that stuff was having our time. Here is where the miners shined. They outperformed gold for about 2 to 3 years max. But after that, they did nothing. They did nothing till 2008. Then after that, they just crumbled price in gold. Look at that. They just did terrible. And here, if ever this is a turn, let's say we will hit it into a recession or something like that, it's possible that once we hit this wall here, this breakout line, this resistance line or area here, that could be it for the miners. The miners outperformance of gold, right? So once you hit that line, you could, even if the miners do go up on their own price charts, you might as well swap everything back into gold and just ride gold, because gold's gonna just outperform.
And not only that, but silver, because we're keeping a very close eye on what's happening with that silver chart, that 46-year cup and handle. We know how silver reacts after stock markets have suffered a severe decline. So silver will have a period of time that highly likely where it massively outperforms gold. So if silver's outperforming gold, but the miners aren't, then you should be in silver. So it boils down to this, Danny. In a precious metals bull era, gold and silver are your measuring sticks. You price everything in gold and silver because either gold will be outperforming silver or silver will be outperforming gold. Whichever way around it is, price your stocks that you're thinking of buying in gold or silver. So pull up a chart for, I don't know, Hecla, the mining company, price it in gold, price it in silver, because if it's underperforming both of those, what's the point? There's not really any point in taking all the risk that comes with a miner when you can just be quite happily holding the metal. And here in the UK, you can buy physical gold and silver and not pay capital gains tax because it's legal tender. And I'm aware of the fact that Citizens for Sound Money, for example, have managed to pass bills in the United States. Florida wasn't the only one. Might have been Texas or somewhere else. They've also made gold and silver legal tender. So I would assume that also means that no capital gains tax. So, that there are big advantages in many parts of the world for having gold and silver, the metal, and not getting involved in the risks that come with the miners. I'm not saying don't buy miners. When the miners are drastically outperforming the metal, have a portion of your NAV in the miners. But, there's no need to feel that you have to throw 100% of your portfolio into mining companies because it comes with inherent risk.
I'll do a fun little game with you, Danny, or Kevin. Kevin knows this game. Here at the bottom pane, I have the instrument, whatever instrument is up here, I have it priced in silver. And I'm just going to show you that once we've confirmed a capital rotation event, there's practically nothing that beats silver. And I mean, of course, there's going to be a whole bunch of penny stocks, stuff like that. But in the major asset classes, look at that. The SPX lost 96% of its value on a monthly close basis. In the 70s, it lost 91% of its value priced in silver in 11 years from 2001 to 2011. Name me something, a major asset class you want me to pop in there, Danny. I don't want to catch you off guard there. I don't know. What could I put here?
I don't know. Do oil?
Yeah, okay, let's do oil. So I put oil. Silver, in the 70s, oil actually did. Look at that. Oh, oil did better than silver, Kevin. It depends where you started, right? Here's the peak. In the 2000s, 2005, 2002, silver did better. In the 2000s bull era, silver did better. So you could say it's a wash. In the 70s, seriously, oil in the 70s was pretty exceptional, Danny, there. It had practically no drawdowns. It just went from bottom left to top right. So with silver, if you take it from silver did do well, depending where you start from 71 to here, but oil did have some nice rallies versus silver. But during the 2000s, oil, bottom left, depends where you started there, but even oil lost a lot against silver. And it's been losing against silver also for a while, actually. My goodness, I never noticed this. Look at that. Oil is down 83% since 2005, price in silver. What about another one we could put there? I don't know, like a Bank of America. Who cares about? Yeah, Bank of America, just terrible price in silver. Oh goodness, a tech stock, Microsoft. What does Microsoft look like against silver? Yeah, even Microsoft did terrible in the 2000s. Look at that. Microsoft lost 95% of its value, priced in silver.
Yeah, and I think Nvidia and
I want to show people that at least one bull cycle for silver. So we grab that one. Yeah, of course, tech. There wasn't that much tech. IBM maybe. Is that people still consider IBM as tech?
That's old tech.
Yeah, well,
that's legacy tech.
But it still behaves the same. Look, in the 70s, it got destroyed. In the 2000s, it got destroyed. So let's see what happens here there. But
using a ratio chart means that you do not have to sit by and watch your portfolio fall by 50% if it's the S&P, or let's say 75% if it's the NASDAQ, because that's how much they fall in dollar terms in these bear market cycles. But of course, when you price them in gold and silver, it's not 70 or 75%, it's 95%, because whilst the stock markets are falling, the metals are rising. So using these ratio charts means that if you have the ability, you can exit those stocks in the S&P and the NASDAQ, rotate them into precious metals, and grow your wealth until the next breakout in favor of the stock markets. And that's the way, if you just play two things, gold and the stock market, it pretty much covers, you know, you got the two competing sectors there, precious metals and the stock market, and they rotate. Capital rotates between the two on a cyclical basis. And for long periods of time, you can do great in the stock market, but then you have a 2-year period that comes along where the stock market dumps 50% and takes 10 years to get back to where it was. Instead of having to endure that, you can take advantage of what's happening with precious metals.
Look at this for copper, Danny. So even copper in the 2000s went up 230% there from the bottom. I measured pretty much the breakout all the way to the top. Oh, great. You did great in copper. Yeah, huge drawdown in the middle, but let's forget about that. But look, versus silver, it still lost 70% of its value versus silver. So the power of the ratio chart is telling you, sure, copper's in a beautiful breakout. I love it. But while you're in love with the narrative of copper, you should have been somewhere else. You should have been in silver, which drastically outperformed. So
well, this is applicable now, Pat, with platinum, because there's a lot of attention on platinum. But if you do platinum versus gold, it's barely breaking out at the moment. I haven't checked it this week. I check it on a weekly basis. But platinum versus gold is only just now starting to break out on the ratio chart. The platinum chart, look, it's spiked upwards and it's broken out and it's looking great. But look at it versus gold on the bottom, or is that versus silver, Pat?
Versus silver again. Yeah, versus silver.
Yeah. So platinum is still in a massive downtrend versus silver, even though it's going up.
That's right. See that? Look at here in the 2000s. Here it's before the capital rotation event. The capital rotation event started after the stock markets rolled over. So here is platinum's performance versus silver. So even if it went up 252%, you're still better off in silver. And silver is going to outperform gold. It's going to outperform practically all the other major commodities. So even
playing platinum there, or copper in the previous example, is like jumping on a horse, going around the racetrack and saying, "I did great," and then realizing your horse finished last. You finished the race, but you're not winning.
So instead of playing the miners or playing platinum and all that, play silver, or play that ratio chart. So if the ratio chart, something else happens in the ratio chart, but previous cycles have shown us that silver is just, it's how could I say, there's no hassle, there's no CEO that could run away with the secretary, there's no bankruptcy, there's no share. It's just it's an easy play. We're not financial advisors, but if somebody wants
less counterparty risk, and it's in your possession.
You want it super simple, guys, and even look, there's SLV there, it's fine. There's no unless you hold it forever and ever, like the rollover costs, like they're embedded in it. There's minimal, it's going to track the price of the actual silver, and
but that's a price you're willing to pay to undo the storage hassle of storing silver.
Exactly.
But then again, if someone breaks into your house and sees a pile of silver, I mean, they're probably going to steal the TV before they steal any silver.
Remember that guy? There's a guy there. He goes around on TikTok or something, and he's trying to give away silver to people. They don't even want it.
Yeah.
Right. And you want a silver coin? You want a gold coin? The people just walk past them on New York. Do you ever see this guy?
No.
So funny.
What's his name?
Trax,
I know you're talking about though, and they may have embellished it a little bit. They may have cut out only the most noteworthy of responses. But yeah, your point is very well taken. I have a tradition that I've adopted from Lobo Tigre, and that is to, whenever we have like birthdays of friends or relatives, I'll send them some silver. Nice. And at first they just look at you just send me a coin. They have no clue what it is. And I've got to explain to them, hey, this thing, it's whatever it is now, $30, $50, $30, $35, $40 now, but just keep track of the price. And I don't know if any of them are actually keeping track of the price or not, but you got to plant these seeds when you can.
Well, exactly. And it was me getting a few gold coins 20 odd years ago that got me interested in all of this in the first place. I was sitting there doing my weather forecasting at an RAF defense station, and I bought a few gold coins with some money that I had. And instead of trying to forecast what was going to happen with the jet stream and what was happening with upper atmospheric temperatures and all the rest of it, instead of looking at those graphs, I started looking at graphs of the price of gold and applying the same forecasting techniques. So, it sparks an interest, and you know, it gets the ball rolling, and it can get people, you know, really sort of involved in trading and investing in a more meaningful way. So yeah, it's a good thing to do in my view.
All right, let's take a quick break from the video to talk about something that's straight up shaking things up in the biotech world. And if you're tired of Big Pharma's grip on healthcare, you're going to want to hear about this. This is ImmunoPrecise Antibodies. The ticker symbol is IPA on the NASDAQ. These guys are coming for Big Pharma's lunch, and it's exciting. So here's the deal. Drug discovery is a mess. Big Pharma's been milking the same slow, crazy expensive process for years, keeping patients waiting and prices sky high. But IPA is tearing that playbook apart with their AI-driven Lens AI platform. This tech is like a rebel scientist designing smarter drugs faster and cheaper than the old guard ever could. Their HYFT technology merges AI with actual lab work, turning ideas into real deal clinical candidates, not just flashy demos that go nowhere. So why is this a big deal? The drug discovery market's set to explode past $100 billion in the next decade, and IPA is already outpacing the competition. They've got patents, proprietary tech, and legit partnerships with major players. Check out IPAtherapeutics.com for details on all their collabs, like with Astellas or InterSystems. They're not just talking disruptions, they're doing it. And get this, IPA is using Lens AI to pioneer AI-designed GLP-1 therapies for diabetes and metabolic disorders. These could be safer, more effective, and here's the kicker, might ditch those daily injections for game changers like transdermal patches. That's a direct shot across the bow at Big Pharma's outdated methods, putting better treatments within reach for millions and shaking up a multi-billion-dollar market. Big Pharma sweating, and investors should take notice. IPA's ticker is IPA on the NASDAQ. Isn't just challenging the status quo, they're rewriting the rules. This is your chance to back a company that's breaking Big Pharma's stranglehold and changing lives. All right, guys, let's dive back into the video. But seriously, keep IPA on your radar. The revolution's happening now. Yeah. One more question here, guys, because Kevin, you sort of alluded to some potential weakness in the S&P chart that we looked at the very start of the podcast. Given the fact that crypto has been on the rise, Bitcoin's at near all-time. It made all-time highs a few days ago. Now it's retraced a little bit back. Isn't the fact that crypto is now getting a bid a sign of liquidity into the market? Are we not back on risk on periods?
We are until we're not, Danny. It's as simple as that. So, you know, we're playing the Bitcoin and crypto charts probably like a lot of people out there and trading it successfully because the price is going up. It's easy when the price is going up, and you take your entry point, you set your trade, set your profit limit, whatever technique you use, everybody's a winner. But yeah, it is doing well until it's not. And the whole point about technical chart analysis is that when the chart begins to break down on daily and weekly timeframes, you can then start to identify the likely ending point for the bull market. But you know, pricing, as I said, pricing gold and pricing Bitcoin in gold and pricing the stock market in gold paints a slightly different picture. In fact, Bitcoin is only back to where it was 4 years ago, priced in gold. Bitcoin peaked in 2021, priced in gold. And despite all of this rally that we've had here from 30,000 to 120,000, Bitcoin has only just got back to where it was 4 years ago, priced in gold. Now, I know everyone's going to be screaming at me saying, you know, zoom out and look at what's happened in the last 10 years. Yeah, we all know that Bitcoin's gone up a quadrillion% versus gold. But we're here, we're now, this is 2025. So what we're interested in is not what's in the rear view mirror, but what the chart is telling us now.
Well, what's the chart here at the, what's the black line telling us? What chart is that?
This is, well, because Bitcoin tracks the stock market. So let's look at the stock market since 1918, priced in currency or adjusted for the currency in circulation. It's just one metric. Often what you like to do is you take a metric that goes from bottom left to top right, let's say whatever it is, GDP, inflation. But then after that, within that, there's cycles. So you can measure SPX versus that major macroeconomic data series. And then you could see the oscillations within that. So here is the crazy Great Depression. The currency in circulation just went sideways, but the SPX just went crazy. I don't think it existed back then, but whatever, they did some math there to make it work. So then you could say, okay, that's a peak. That's one peak. Here's the echo bubble. Here's another peak. Here you have the Nifty 50 in the 60s. It hovered around these peaks here. So now I'm having this line here, this pivot line morph into existence. Here's a 2000.com bubble. And it's fine. It could keep going up and up. But once you start having an acute rising trend line in there that morphs into existence, keep an eye on it. Because if ever you get a close below that, that's that upwards momentum is slowing down. And that's just the step one of a possible turnaround, right? With hindsight, we'll know, okay, that was the peak. But watch that for that. So right now, we're still climbing 1, 2, maybe on the short time frames, I would have had a touch here. So as long as the SPX is able to outperform currency in circulation in this occurrence, it's fine. It's an uptrend. Everybody's happy. People are trading cryptos. All your bullish trades are working out because it's going up. But if you look at it from a statistical perspective, most of the black line, where is it, Danny? Is it above or below this dashed line?
It's below.
Yeah. So eventually there will be a reversion to mean, and I don't even know if that's the mean, but it will go below that line, and it will go below and stay below, and then bottom, and then after that it will eventually re-go up. So yes,
what's the currency? What's the ticker symbol for currency in circulation? We often just use M2 money supply.
Yeah, you could use it. CURR, CURR,
and that captures, I guess, the money supply of all of the various currencies across the world, or how does that?
No, it's I think there's the U.S. actual currency there, cash or whatever is being used. We'd have to ask ChatGPT for, but it's is the M2 a subset of it, or that's a subset, or it's slightly different? It's maybe all the banknotes, stuff like that. It's different. It's not the same exactly. I could measure it in M2. It's not exactly the same, but yeah, do the same exercise with the M2. If you're stretched, and just plot anything, price M2, and then see how stretched you are. And then
if you look, actually, Pat, US M2 is starting to reaccelerate upwards.
Mm-hmm.
So your chart there, which is the stock market priced in US M2, is going to have downwards pressure because US M2 is going up, which it hasn't been for quite a long time. US M2 has been falling and then consolidating. US M2 is now starting to uptick for some fairly obvious reasons, I think, that we probably don't need to go into here. But
sure.
Currency in circulation and debt in the US and all the rest of it is looking like it's about to take an upwards leap.
Just really quick, why is it going up? Give us like the Cliff Notes version.
So in terms of debt, you're talking about extra trillions being added by the big beautiful bill for a start. So, different economists have calculated just how much that's going to add to the debt burden. And from what I've read, and I'm no expert, but from what I've read, the sort of middle estimations are somewhere around $4 or $5 trillion. So I would imagine that currency in circulation will follow that trend.
But would that have been already reflected in the M2 money supply statistic yet?
I don't believe so, looking at the chart, because it hasn't moved up to a great extent. And if you look at the US total debt, I'm not sure when that number gets added precisely, and the mechanics of how long it takes that number to be added.
I don't think it's in there, Danny.
But it has been reaccelerating. The M2 money supply has.
Yeah. It's right there.
It's at all-time highs now.
So look, Danny. The long story short, it doesn't really make any difference whether you're looking at a Democratic or Republican administration. You zoom out and look at the direction that the money supply and U.S. debt has taken over the last 50 years, and it makes no difference who's in charge. The chart just goes up and up and up. But the point is, when it reaccelerates, it's not so much the fact that it's going up, and Pat's spoken about this before. It's about the rate of change of that debt burden. The rate of change is how quickly things are changing, not the fact that it's just going up. Because we're used to the line going from bottom left to top right. The economy is set up for that. We're geared up for 3% inflation, prices continually going up, money supply continually rising. It's not the fact that it's rising that's the problem. It's the rate of that rise that causes the shocks.
Yes, it's not. I'll just real fast there before we close up there. Here is the SPX price in M2. So it's getting stretched once again. That's why I use currency in circulation, because I have data going back further than 1959. I get the other bubbles, but you see now we're in uptrend. It's fine until it's not. So here's a .com bubble. The SPX wasn't able to outperform the M2 more than this. We're approaching once again this outlier territory. But guys, you don't front run this, right? You just wait. When this black line, 1, 2, it's a valid rising trend line. When that black line falters, that's when you got to be really, really careful, especially if it falters because the SPX is starting to lose ground, not because the M2 is going down. That's going to be, and there's so much more evidence that you could add to that. So we're not, look, Danny, if I show you this chart, where is the low risk entry for the SPX there? Like we all know it's like, yes, we know it bottom 2009, but here you started getting some breakouts here and stuff like that. The low risk entries were down here somewhere in 2013. And now it's not low risk entry anymore. It's the opposite, right? That's why we're not telling people it's the end of the run. We're not going to call the top there. The top, we're going to know a little bit in hindsight. We might have some, but we're telling people, when people say, oh, it's so early, you're starting to hear that with Bitcoin. I hear that. Oh, it's so early, guys, so early. What are you talking about? It's so early. It is not so early. It's like, unless you have 100-year time frame, of course, now it's early. But the early part was 2012, 13, that area. That was the early part. My goodness, it's not early.
If you have a 100-year time frame and you expect to live for 200 years, Pat, then yeah.
Well, of course, because it's destruction of purchasing power. These charts are bottom left to top right. We all know that. That's like destruction of the fiat. But right now in this cycle, it is late in the cycle. We are late stages in the cycle. It's not like unemployment's high and unwinding. It's the opposite. It's slow and starting to go up. So it's there, guys. But it's there.
It's there. Okay. Well, I think I know you guys have a hard stop here in about 4 minutes or so. So thank you so much for your time. Where can people find you if they want to see more of your work? Go ahead, Kevin.
Yeah, it's right there on the screen there. NorthStar BadCharts.com is where you'll find myself and Pat. I don't know why Pat's isn't on there. Yeah. Slap Pat's wrist. And I'm at NorthStar Charts on X, capital N, capital C. Pat?
Yes, BadCharts1 on Twitter. And guys, hang in there. Keep following our Twitter, because we'll be launching our summer promo soon. So go make sure you don't miss that out there. We should put some news out in a short while.
Gotcha. All right, we'll have the links to your website and Twitter handles, or X handles, my mistake, down below. Guys, I mean, Pat, you should get like a tattoo of your Twitter handle on your arm or something. I know, right? That way, you don't have to wear that hat anymore. You can just go like this and show off your website and your handle. But be that as it may. Thank you guys so much for your time. If you guys enjoyed the podcast, drop us a like, comment down below. Go, Kevin, go, Patrick, go. If you disagree with anything, let me know what you disagreed on. I do, in fact, read the comments. Subscribe to the channel so you don't miss an episode. And liking, subscribing, commenting, sharing the video, all of it goes a long way in helping push this video and this channel in the algorithm. So if you want to get this message out to as many people as possible, a little bit certainly does go a long way. And check us out on Substack at capitalcosm.substack.com to get early access to all of my videos, uncensored versions, ad-free versions, etc., and the ability to recommend me guests, DM me, and make provide questions to any of my future guests down the line. Thank you guys so much for watching. I will catch you later. Bye.
Bye, guys.